Oil spikes after Iran strikes, the Fed hints at more hikes. Can crypto survive this double gut punch? Let's start with the story shaking global markets today. Iran struck multiple targets over the weekend, sending crude oil prices surging more than 5% in early trading. Energy markets haven't seen this kind of volatility in months, and traders are bracing for ripple effects across every asset class, including digital currencies. Adding fuel to the fire, the Federal Reserve signaled that interest rates could still climb higher despite recent progress on inflation. Fed officials pointed to persistent price pressures and geopolitical risk as reasons to keep policy tight. Higher rates typically make riskier assets like Bitcoin less attractive to institutional investors seeking safer returns. So, how is crypto holding up under this pressure? Bitcoin has shown surprising stability, trading in a tight range even as oil spiked and rate hike fears resurfaced. Analysts say this could signal a maturing market, one less reactive to short-term geopolitical shocks than it was in previous years. But the real test may still be ahead. Next, a story that's been quietly building for years but just took a major leap forward. IBM announced what it calls a trusted quantum advantage, claiming its latest quantum computer solved a problem faster and more reliably than any classical supercomputer could. This milestone brings the tech industry one step closer to machines powerful enough to threaten today's cryptography. Why does this matter for crypto? Bitcoin's entire security model relies on cryptographic puzzles that are, for now, practically impossible for regular computers to crack. A sufficiently powerful quantum computer, though, could theoretically break the encryption protecting private keys and wallets. IBM's announcement doesn't mean that's happening tomorrow, but it does shorten the runway. Developers across the crypto space have been researching quantum-resistant cryptography for years in anticipation of this exact moment. Ethereum, Bitcoin core contributors, and major blockchain foundations have all published roadmaps for post-quantum security upgrades. The takeaway here isn't panic. It's that the clock on this transition just got a little louder ticking. Now let's talk about Wall Street's growing grip on crypto trading. New data shows institutional trading now accounts for a record 72% of total crypto market volume. That's the highest share ever recorded, and it marks a dramatic shift from the retail-dominated markets crypto was known for just a few years ago. This institutional wave is having a noticeable calming effect on crypto's notoriously wild price swings. Large trading firms, market makers, and asset managers bring deeper liquidity and more disciplined strategies than retail traders typically do. The result is a market that behaves less like a casino and more like a traditional asset class. For everyday investors, this shift means both opportunity and change. Volatility that once created dramatic swings, for better or worse, may become rarer as big money smooths things out. Some see this as a sign crypto is finally growing up. Others worry it could dilute the very unpredictability that made early crypto gains possible. Moving to a story about the fallout from July's brutal AI stock sell-off. The Financial Times reports that a hedge fund called Situational Awareness, holding over $1.1 billion in Bitcoin mining stocks, is now scrambling for fresh capital. The fund reportedly used borrowed money to amplify its bets, and that leverage turned against it hard. When AI-linked stocks tumbled last month, mining companies with heavy ties to AI infrastructure and chip demand got caught in the crossfire. Situational Awareness has approached both investors and lenders looking for a financial lifeline. This story highlights just how tightly intertwined Bitcoin mining has become with the broader AI and semiconductor ecosystem. It's a reminder that leverage cuts both ways in volatile markets. What amplifies gains during a rally can just as easily amplify losses during a downturn. This situation will be one to watch closely, as it could signal broader stress among funds that bet heavily on the crypto mining meets AI trade. Next, a major sanctions story out of Washington. The U.S. Treasury has sanctioned an Iranian maritime firm called Hormuz Safe, accusing it of accepting Bitcoin and other digital assets to dodge sanctions. According to Treasury officials, the company generated revenue that flowed directly to Iran's Islamic Revolutionary Guard Corps. This case underscores a persistent tension in crypto policy circles. The same properties that make digital assets appealing, speed, borderless transfers, and pseudonymity, also make them attractive tools for sanctions evasion. U.S. authorities have ramped up crypto tracing efforts significantly over the past 2 years to combat exactly this kind of activity. Officials say this action is part of a broader crackdown on Iran's use of crypto to fund military operations. Expect continued scrutiny of crypto exchanges and mixers that may be facilitating similar transactions elsewhere. It's another sign that regulators are treating blockchain forensics as a frontline tool in geopolitical enforcement. Now for some calmer economic news. The Fed's preferred inflation gauge, the PCE index, posted its first monthly drop in 6 years. That's a notable cool-down signal, and it arrived right as fears about a South Korean semiconductor rout started to ease across global markets. Bitcoin and U.S. stocks both enjoyed a relief bounce following the data release, since the inflation figures came in right in line with year-on-year expectations. Markets had been bracing for a hotter reading given recent geopolitical noise, so this softer print offered a welcome breather for traders across asset classes. This kind of stability matters because it gives the Fed more room to maneuver without triggering panic in either direction. For crypto specifically, calmer inflation data tends to reduce the pressure that pushes investors towards safer, more traditional assets. Still, one data point doesn't erase the broader uncertainty hanging over markets this week. Finally, some standout earnings news. Robinhood just posted its best quarter ever, pulling in a record $1.31 billion in revenue. The trading platform's stock has been on a tear, and this latest report gives investors even more reason to pay attention. What's driving the growth might surprise you. Prediction markets and Robinhood's new blockchain initiative called Robinhood Chain are now doing the heavy lifting that crypto trading used to provide for the company's bottom line. This marks a notable shift in strategy as Robinhood diversifies beyond its traditional stock and crypto trading business. Prediction markets, where users trade on real-world event outcomes, have exploded in popularity over the past year across multiple platforms. Robinhood's ability to capitalize on this trend, combined with its blockchain ambitions, suggests the company is positioning itself for a future well beyond simple stock trading. It's a strategy worth watching as competitors take note. So here's the big question for today. With oil prices spiking, the Fed signaling more hikes, and geopolitical tension rising, do you think crypto is finally mature enough to weather this storm, or are we due for another wild swing? Drop your thoughts in the comments below, and if you want twice-weekly deep dives into the stories shaping markets and technology, hit subscribe so you never miss an update.